Last time I looked at stop losses for two different categories of mean reversion strategy. Today I turn my attention to breakout strategies, where the concepts tend to be very different. Darwinex is a UK FCA regulated broker and asset manager on a mission to disrupt the financial trading, investing and asset management industries. If you're a talented trader looking to attract investor capital to your strategies, Darwinex is the fastest way for you to do this. We enable traders to raise third-party investor capital and then charge success fees on high watermark profits. Additionally, Darwinex itself invests in its traders with our seed capital allocation program that allocates up to €90 million per year in successful trading strategies. So, if all of that sounds interesting, learn more by clicking on the link here, or you can find further links in the description right below. Now back to today's tutorial. The logic behind the calculations of your stop loss levels are determined by the type of strategy you're trading and the typical price action that the strategy is based on. Today I focus on breakout strategies. This is the price action that we've looked at previously for the S&P 500. And this is the breakout here that I'm going to focus my attention on. So as a very quick reminder, in previous episodes I've talked about the concept of not trading the breakout from a range itself, but instead waiting for the breakout to occur, giving you the chance to make a proper judgment about whether this is a false or a true breakout, and then waiting for a pullback. And very often these pullbacks will go all the way back to this level of support. And the reason for this is that you have that chance of determining if this is a valid breakout or not. Whereas if you trade the breakout, you have absolutely no idea. Now, in terms of setting your stop loss, where's the best place to do this? Well, this will be determined by your specific rules, but a good rule of thumb is that, of course, you would set it underneath this level of support, which during the time of the trading range, this was acting as resistance. But now that that price has been broken, it then becomes a level of support. And so this is a natural barrier that will help to then push price further up. So it makes absolute sense to set it below that level. There's no point at all setting it at the level of the breakout and the retracement that you can see here, because very often price will encroach into this trading range again, as you can see in this particular case. So if you did set your stop loss here, you'd find that you'd be exiting at this very frequently. Now, where you do set it below this level will be determined in part by what your take profit level is anticipated to be. So in previous episodes, I've explained how the distance of the range itself can be used as an initial take profit target. And so if we draw a level here, which is approximately the same size as the range. Now, when you use a profit target of this nature, so you're a very short-term trader if you do, then your stop loss probably needs to be a little bit tighter than if you're going to let your profits go for longer. And so, for example, setting this a third of the way down the range would give you a reward to risk ratio of 3:1. Setting this at the midpoint of the range gives you that reward to risk ratio of 2:1. Now, I'm not a great lover of reward to risk ratios without also thinking about probabilities of those levels being hit. So for example, if your backtesting suggests that a trade open at this retracement level here has a 75% probability of reaching this level, and only a 25% probability of reaching this level at your stop loss, then that would produce a really good system in the long run, because you'd make twice as much profit on the trades 75% of the time as you do on the stop loss exits, which only occur 25% of the time. So if we think of this in dollar amounts just to make this easy, and we imagine that this produces a $1 profit, that means that 3 of the trades produce that profit, making $3. One of the trades produces a 50 cents loss, so that's an effective reward to risk ratio of 6-to-1, not the 2-to-1 that you get just by looking at the levels. And this is a really common misconception that I see discussed lots on different trading forums, where it's only the distances that are taken into consideration by the traders as they discuss this. But of course, this 2-to-1 ratio is completely meaningless if you don't know what the probability of hitting those levels are. So I always take that into consideration. And so for me, if those were the probabilities, that turns the 2-to-1 reward to risk into a 6-to-1. And that for me is the proper way of performing this calculation. Now, if instead you are a slightly longer term trader, and instead of just going for this initial breakout, you decide that you want to set your level much higher to take advantage of a longer term trend, so let's say for example that you set your level here, then you might be better off giving more room for maneuver with your stop loss and maybe setting it even below this level here on the trading range. Because by setting your take profit level up here will obviously have an impact on that reward to risk ratio. And so by setting your stop loss here will maintain a similar reward to risk ratio, but also gives you that additional protection of this level of support here. So we actually have 2 levels that will hopefully have a rebound effect on the price action, and in this case the price would actually be allowed to come straight back into the range, meaning this was actually a false breakout, and then have another chance to break out in the future whilst our stop loss protected us throughout that time. But again, you still need to think about probabilities. What is the probability that this take profit level will be reached? What's the probability that the stop loss level will be reached? And then combined with the difference in the distances between these, that will give you your true reward to risk ratio. So we've now covered various techniques for setting your stop loss level based on both mean reversion strategies and breakout strategies. In the next episode, I'll turn my attention to trend continuation strategies. So thank you for your time today. It's been a pleasure having you here with me. And now until next time, trade safe.